Rivian Automotive is potentially on the cusp of a massive growth story, not only in terms of brand image, technological innovation, scale, but also profitability and market share. Just today, Rivian released its third quarter's delivery and production numbers that came in well over what Wall Street had expected in the midst of a global EV slowdown as well as high interest rates. That is certainly a very impressive performance. All in all, Rivian for the first half of 2023 has now produced 23,000 of its R1T and R1S trucks. And particularly in the third quarter, they produced 16,000 of those vehicles with deliveries of 15,500. If you analyze that number, that comes to around 50K units on a conservative analysis. And Rivian themselves have set out their target at only 52K for the full year 2023. That, folks, is very impressive because Rivian now is on track to deliver more electric vehicles from a startup than any other company based out of North America, apart from, obviously, Tesla. It puts the company dead center in the second place when it comes to EV startup market share, and certainly gives this company a really good outlook when it comes to developing its own niche around the trucking, adventure, and off-roading segment, which we all know is extremely popular here in North America. And the most impressive part is that Rivian right now is manufacturing all of its vehicles in only one plant based in Normal, Illinois. And that just happens to be one of the reasons why Rivian on paper is still losing cash per quarter, which is all because of their massively high power facility that is only just churning out a limited number of vehicles as a percentage of its maximum rating. Rivian now designs, tests, and integrates nearly every component of its vehicles in-house in this Illinois factory, except for the battery pack and the battery cells, which are obviously supply chains owned by big companies like LG, BYD, and Cattle. And this aggressive focus on vertical integration from an early standpoint is giving the company a lot of benefits when compared to some of the competitors in the space like Lucid Motors, who is currently seen struggling not only selling its expensive $100,000 sedans, but also struggling to reduce expenditure for every vehicle on the line. This impending success in the consumer market is also translating side by side with success in the commercial market, as seen by the outlook of the electric delivery van and Rivian's Amazon partnership. Amazon not only backed the company from a really early standpoint, which validated the company's progress as an EV startup, but Amazon's partnership also provides a capital injection and credit line opportunity whenever the company needs to raise capital to increase its production. And as for when exactly production will be ramped up consecutively for Rivian, it all depends on how fast they deliver the vehicles and how much demand there is from their backlog and customer acquisition sites. And that, folks, also just so happens to be one of the areas where Rivian has a good benchmark, because not only is the company witnessing one of the best customer satisfaction rates for both of its products, but it also has one of the fastest growing registration rates in a state like California. Yes, folks, you heard that right. Year to date for 2023 compared to year to date for 2022, Rivian tops the charts by a huge margin in the percentage change in brand registrations, at least for the top 30 selling brands in California right now. And as you can see, it dethrones not only the other EV players like Genesis, Polestar, and Tesla, but also established brands that it is essentially competing directly with by the likes of Land Rover, Porsche, Volkswagen, and yes, even BMW. And at the very bottom of the list, we have companies from no other than Stellantis struggling like Jeep, Chrysler, Ram, and Dodge, who are not only facing reliability issues, which are phasing out competition for Rivian, but also issues with brand recognition and getting enough sell-through from dealers. This means that Rivian is undoubtedly the fastest growing American-made startup in 2023. And that certainly gives it a long opportunity for growth in the form of market share, which will translate into revenue, and the cost efficiencies I just outlined for Rivian can start to translate into new gross margin improvements as newer products are launched going into 2025. The main issue with Rivian has always been valuation, and that just so happens to be one of the reasons why the stock is down significantly from its $177 high it saw right after its IPO in 2021. But after a massive decline, we are starting to see sanity get back into the markets as people are realizing that there is opportunity for growth in the EV sector for a company that has a lot of good backing. And a $22 billion valuation on sales of $3 billion is still very attractive, especially if you compare it to a company like Tesla, which is trading at a price of sales of a whopping 8.38. This doesn't mean that Tesla is a bad investment, and I am definitely not making any form of judgment. I am just looking at the numbers, looking at the opportunity, and looking at the track record of these companies to understand where there could be a differentiator and where there could be some similarities. And the most interesting part is this has been a string of delivery beats for Rivian so far in 2023. Whereas somebody like Tesla for the third quarter just happened to miss those same delivery estimates. The company did indeed lower its production guidance for the rest of the year, but chances are they could potentially raise it if demand starts to go up going into the last quarter, which has historically always been the strongest for the EV sector. Because if you do the math, to reach its 52,000 goal for 2023, Rivian now has to deliver 12,000 vehicles in the fourth quarter compared to 15,500 for the third quarter, which in my opinion is an extremely easy goal to achieve because of the seasonality I just mentioned. And putting that in the context of Rivian having had its biggest revenue quarter in the second quarter of $1.12 billion, chances are this growth could re-accelerate compared to last year. And that is certainly something that is lacking in the automotive industry right now, as investors are frolicking from not only conventional OEMs, but also any form of EV startup that is witnessing slowing growth. And the best part for Rivian is not only is it now number 2 on the rankings, but it also has one of the best financial positions out of any homegrown EV startup, with a cash and cash equivalents of $10 billion, resulting in a total asset pool of $17 billion, including their facility in Illinois. And that only has to cover debts that are sitting at around $5.5 billion, which means they can pay off all their debts and not have to raise any cash over the next 2 years. And hopefully, based on new capital injection and investments as well as scale, Rivian's gross margin should hopefully start ticking up into the positive sometime at the end of next year, which certainly could coincide with a simultaneous flip in sentiment from Wall Street investors. Now, obviously, folks, there's a lot of ifs with the analysis I just shared, and this is certainly just my opinion on what's going on with Rivian as a company. All I'm going to say is that it just happens to be one of the most successful and underrated EV stories in the market right now, with a product that differentiates itself, provides a great brand image compared to a very, very stale auto pickup industry, as well as having a good financial footing and decent execution over the past 2 years. As usual, folks, let me know your thoughts on the situation down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.